when the company actually reports earnings, the profit margin, say, for Amazon, it's like 3.5% profit margin. So if it goes from 3.5% to 3.6%, that 0.1 change, I promise you, is worth tens of percentages, right? So that stock will go up 10, 20, 30% potentially if they can just change the profit margin. Because when profit margin changes today, investors understand that that is going to be different for the forever future. This company has found some efficiency in the market, okay? Those little things that are super specific, nobody talks about on YouTube. Hey, this video, we're gonna be talking about how the stock market actually works, the behavioral finance side of things, as well as technical investing, value investing, fundamental investing, and some of the best advice I've gotten from my time at Goldman Sachs. What I've learned from building a portfolio, actually 2 portfolios that are a total of about $5 million at this time. I'm gonna be sharing with you guys the secrets because way too many of you guys are actually completely doing the wrong thing. I know I'm 30 years old right now, or almost 30, but I have some white hairs, I have some white hairs, I have some wisdom here, some experience. There's a reason why I have millions of dollars. It's because I went through all of these mistakes that you right now are making in your portfolio, whether that's chasing profits or going after hype stocks or not picking the right, stock selection, not choosing the right strike prices on options. I'm going to be covering all of these things and pretty much giving you, some life advice on how to make more money, but also how to change your mind around making more money. Because with option trading and the stock market in general, what you have to realize is this is a biological game, not a financial game. If you look historically, the market always goes up, but there's lots of volatility. There's crashes in the market. Now, the reason why there's crashes is because people get really enthusiastic about the market. They end up, getting really happy and then over predicting what's actually happening in the market. And when the market pulls back, they end up having too much fear. They end up overreacting on the downside. So that's human nature. Success often lies in catching trends early and riding those trends before they become mainstream. We've seen that all across the board right now with AI stocks, with technology companies, especially something like Nvidia, as well as other stocks like Tesla back in 2021. Now, Tesla's coming down a lot, and you need to understand how trends work to actually make money. It's not about fundamental analysis, it's not about technical analysis. It's actually a question of, do you understand other people? Warren Buffett says, be fearful when others are greedy, and be greedy when other people are fearful. Right now, the market is not fearful. The market at this point in time is doing very well. You want to be very cautious when the market is doing well, because when things are all like dandy and everything is good, that's actually the perfect time for you to be more cautious, because oftentimes the market does unexpected things. In fact, when I was working at Goldman Sachs, one of the most popular things, or one of the things that really blew me back, was this financial advisor who was managing like $1 billion. He said the point of the market is to make the most amount of people feel stupid. Literally, the point of the market is to prove the most amount of people wrong, okay? So if you want to be successful, you cannot really look at what is happening out there in the market. For example, you can't be copying the most popular trends. You actually need to spot early trends before they are popular. That's why I always say, looking at YouTube for stock advice and basically looking at whatever is hype, like we see what's hype, right? You see those stocks being covered all the time. Those hype stocks are the exact stocks that are likely to pull back, and they're really likely to experience a lot of panic selling. You never want to invest in a business that you don't personally understand. That's why I tell everyone, you want to keep investing very simple. For me, I've grown a portfolio that's pretty large, right, at a pretty young age, and that's because I've stuck to very simple things. Yes, I've invested in things like Tesla, but I've done my research on Tesla back in the day, and recently it's been pulling back a lot, and I've shifted my attention to Apple and Google. And that's because I think brands and companies that have a strong brand are going to continue to do well. The biggest secret in investing that isn't covered on YouTube is the little things. For example, margin expansion. You may not even know what that is. Margin expansion is basically when you look at the profit margin of a company. Is it going up? Because oftentimes, for example, I used to be an analyst for software, and I was looking at Activision Blizzard, which is a company that is part of esports, they have video games. And I was taking a look, and basically because they had some software apps that had really high profit margin, and that part of the business was growing, which in business school we talk about profit pools. When there's a company that has a small division that is growing very rapidly with high profit margin, that's actually a very good thing for the overall company. Now, obviously it's a good thing for the overall company, but why? It's because when the company actually reports earnings, the profit margin, say, for Amazon, it's like 3.5% profit margin. So if it goes from 3.5% to 3.6%, that 0.1 change, I promise you, is worth tens of percentages, right? So that stock will go up 10, 20, 30% potentially if they can just change the profit margin. Because when profit margin changes today, investors understand that that is going to be different for the forever future. This company has found some efficiency in the market. Okay, those little things that are super specific, nobody talks about on YouTube. Everyone's talking about the innovation and why the stock's gonna go up and the latest news. That type of stuff actually doesn't matter. The type of news that comes out that's live, it's already perceived by everyone else. You're not the first one to get this news. Everyone has this news, and the stock market adjusts really quickly to that news. That's because the stock market is an expectations game. Whatever is expected in the market, if there's a surprise, that's when the stock moves. Now, there is a paradigm to investing, which is you need to spot new trends early, but most of the time, those trends are smaller cap companies. Although I'm an advocate for going after large companies that are not growing as fast. So how do you balance this paradigm? Well, this paradigm exists in all areas of life. You need to mix around your decision making. Okay, so I have actually a decision making degree. I have a business analytics, data analytics degree. So in terms of mixing around your strategy, what you need to do is, for example, in option trading, I personally prefer a little bit of poor man's covered calls, 5 to 10% in poor man's covered calls on big cap stocks. That's because, for example, big cap companies are very stable and growing, but they're not gonna grow that much. That's why I would use a smaller, more leveraged strategy like the poor man's covered call to invest in stable technology companies. That way, when they do go up, let's say 10% in a given year, which is what the stock market typically does, I can actually benefit 20 or 30% because I'm using a leveraged option strategy that is safe. Now, I'm going to contradict myself because I said I don't like hype. But the fact of the matter is some hype is okay, but you have to properly allocate how much money you want to put in to hype stocks. And that's because hype stocks are, in a way, very high growth and they do have really huge potential. That's why they're so interesting to you guys and all investors, including myself. And that actually is very interesting because in finance school, I was learning about private equity. What private equity companies do is they give money, for example, like angel investors in Silicon Valley. They will take $1 million and they will give it to 100 different people. So they have $100 million and they give it to 100 people. Now, out of 100 people, to be honest, 95% of those people are probably going to completely lose money. They're not going to succeed. 4 out of those 100 people may make a small return, that company may turn into something, and then 1 out of 100 people, maybe will become the next Airbnb or the next Uber. And that investment will go from $1 million to like $400, $500 million. So they can 5x their money just by finding one huge winner. And that's why it is interesting to invest in hype stocks. However, you need to properly allocate to hype stocks, for example, 2 or 3%. Like seriously, one of the best pieces of advice is you should have a majority of your money in very safe companies that you're just riding for the long term because you're going to be investing for 10, 20, 30 years. So you want to have most of your money in safe companies. However, you want to have a portion of your money in riskier companies as well because that's what makes life spicy. That's like the flavoring of life or investing. You want to have some risk because maybe that small risk can turn into an outsized big return, which will make you very happy, keep you interested. And overall, it can be good for your portfolio. And also, I just know that most people can't do the boring stuff, which is just have a portfolio that's full of Apple, Google, Microsoft, and other like really big S&P 500 companies selling covered calls for income, just like I do. You want to have some excitement. That's totally okay. I think you can have some smaller cap stocks. However, each one, again, has to be a small portion of the portfolio. And that does depend on the person. Some people, they can have 3 to 5%. And other people, because you have a longer time horizon, okay? If you have longer time horizon, you can have even 10% of your money in riskier strategies. Now, obviously, you want to learn from your mistakes. This is super cliche. Like, I've been learning from my mistakes from the very beginning, and I'm still learning from my mistakes. but you need to adapt to the market. You really need to study what went right and what went wrong. That's the same thing with sports, it's the same thing with chess, it's the same thing with dating. You need to look back and see, where did you go wrong? Because if you do that analysis, I promise you, you will have much better results in your trading. Now, the next thing I really want to talk about is risk to reward ratio, as well as your time. Okay, this is something that is actually contradictory to my channel, because I like to obviously put out advice here, and I am a trading coach. I have a Discord program, and this is actually going to go against me, which is you actually need to trade less. You actually need to not pay as much attention to the market. You actually need to back off more. You need to factor in the time that you're putting into investing. If you're spending like 6 or 8 hours a day trying to invest, I think that's the silliest thing that you could ever do, because at the end of the day, you're not really going to outperform the S&P 500 in the stock market index by that wide of a margin, okay? If the stock market has a 10% return, maybe, okay, we can achieve long-term 24%. I've had a 7x return one year. I've had a 10x return the other year. I've literally turned 100K into $700,000. I've done that. But the thing is, on a long-term scale, I cannot do that. I'm not better than Warren Buffett. I'm not better than Peter Lynch. I'm not the best investor in the world. I took a significant amount of risk before. It really paid off for me. My strategies work, but I'm not delusional to think that I can continue doing that forever. So the fact of the matter is, if you want to scale your portfolio, you actually need to take a step back and make smarter decisions, not work harder, not get obsessed with the market. You actually need to de-obsess and have a system in place. For example, you have 12 different stocks, equal weighting across all 12 stocks, doing covered calls on a monthly basis, and then you're hands off. You're not paying attention to it every single day. What if it's going up? Do I cut my position? No, you don't want to panic that way, because the more action you take in your portfolio, actually the worse results you get. Not to mention all the time that you're spending investing, you could be making more active income. Maybe you only look at your portfolio once a week, once a month. There is nothing wrong with that, because when you set it and forget it, which I forget where I got that from. I've heard that very, very long ago, but actually there was like this famous guy, right? Something about the Super Bowl. He like ran out and said it, forget it. I don't remember what his name was or anything, but that was actually recently brought up in social media somewhere. Anyways, set it and forget it is something that I've basically been following for the past 10 years. And it's pretty crazy. About to be 30. And I started investing a decade ago. And as you can see, wow, I have a whole 10 years of experience here, and I've made multiple millions of dollars investing, as well as coaching and other things. I've done really well financially. But the point is, I've been consistent. I've never stop thinking about it, but I've also not really obsessed over it, because obsessing is where you make a lot of issues. So there's a really fine balance, and trading is totally an emotional game. That's something that no one's going to tell you. Everyone's going to tell you that they have the next secret, buy their course. And I'm sure at this point you guys have purchased other people's courses. Typically, they are really, really bad. These courses are typically just going over the basics, or they're just regurgitating information that they're already covering online. These people are not even qualified, besides being really good at YouTube and marketing. So what you want to do is not invest in more programs, is not spend more time on investing. It's actually to focus on the fundamental basics of investing, which is buy quality companies, put 80% of your money in safe long-term positions, and then maybe 20%, the 80-20 rule, you probably heard about it, put 20% of your positions in maybe higher risk stocks, maybe higher risk option strategies, and more fun plays and more trendy plays, because that 20% can make a lot more than the 80%. However, you don't want to just bet on that happening, because like most things in life, not everything works out. Not every relationship works out. Not every financial decision works out. Even the most basic things in life, they might not work out. So you want to have a protection plan of an 80-20 split in your portfolio. And look, you want to plan for longevity. Even if you're 60 years old, you may live to 100 years old. You never really know. So you want to over plan the amount of money that you need. I'm just making money at this point that I don't even need. However, I still don't know. Maybe there's going to be some technologies that make us live forever, or who knows. Making more money and overshooting your goal is really important. Maybe I'll have lots of kids. I don't know yet. So for me, it's really important for me to plan for more than I need. The same thing should be happening to you. Yes, you could retire in option trading with just $500,000, $700,000, but you want to aim higher. You want to aim for having a lot more money, because maybe you'll want to pass it down. Maybe life and inflation will get a lot more expensive. So you want to plan for longevity in your portfolio, which is a long-term plan. And a lot of that long-term plan is honestly not even financial, it's mental. What do you want to achieve at what time point? And plan long term. And the last thing I want to say is the best investment is yourself. So keep investing in your knowledge and keep planning for where you want to be in the next 5, 10, and 15 years.